from the free money allure. My name is Daniel Anzueto. I welcome all pronouns and serve as community engagement manager at StartOut. I'm excited to welcome you to today's event. If this is your first time attending one of our workshops, welcome and know that StartOut's mission is to increase opportunity and success for LGBTQ entrepreneurs. I'm grateful to introduce our host for today, Karan Singh from Joyus Studios. The floor is yours, Karan.
Thank you, Danny. It's been a pleasure getting to do these with StartOut. StartOut is it's a really lovely community. It's if you ever have an opportunity or are looking for sources for mentoring or just a community as a queer entrepreneur, StartOut is really an amazing resource, and it's been great to me also. What we're talking to you about today is the second one of the series we've been doing about fundraising. So last time we talked a little bit about where does that first check come from, right? When you have this idea, how do you go out and get your first piece of money? And today what we're talking about is what are the implications of that money, right? So you've gone out, you figured out, oh, I'm going to get this check. Well, what does that mean, right? What is going to happen to my business because I'm doing that? So a little bit first, though. So what is Joyus? Joyus is the company that my partner Divya and I started. She's really the designer. I'm more of a poet, writer myself, but we both have a long background in technology, and we've been blessed to kind of work with really amazing people over the years. So we put together this collection of people who are just excited about building things that they care about. And it's really nice to be in that point in the career where you can kind of be focused on building the things that you really care about. So like I said, though, today we're going to be talking about capital, about what it means, about the implications of it. And I'm going to be zeroing in on three kinds, right? These are not the only kinds of capital, but these are three that can really give you good coverage if you understand these three different types, and then also can just be a good guide as you're kind of out there figuring out what you're going to do next. Now, of course, though, I feel like it's very useful to kind of spend a little bit of time on just defining what we're going to be talking about today. So what I'd love is if you'll have a piece of paper, you have your phone, you have something. We take a minute or two. Yeah, we've got plenty of time. And just what do these things mean to you, right? And if you are willing and you're able to kind of put it into the chat, I would love to see that. But we'll just take 2 minutes now with these three questions, right? What is capital, right? Why do people take it? And then why do the investors give it? I won't make you sit in silence for too long. Don't worry. Let's see if I can find the little messagey thingy in the meantime. Yes, we're Zoom. Over here. Here it is. I'll give you guys another 20 seconds or so. I think it's really useful to spend this time because it's useful to even acknowledge what definitions you have yourself, right? Even when you're going to be about to especially when you're talking about some of these amorphous concepts that you kind of heard for a long time, but you may or may not have really spots to be like, what does this actually mean? Okay, I like these answers. And especially that second one that Nick gave. I'll talk to that point particularly. Many unusable resources and some strings. Yeah. Okay. I mean, everyone's kind of focusing on the financial side, which is obviously the side we're going to be talking about today. But I do like to kind of call out that capital includes time and it includes relationships, right? And I think particularly the time aspect is one that we all so easily, as entrepreneurs, as people who care about what you're doing, we forget about that aspect. You can convert your time to money. So there's obviously an analog between your time is worth some amount of money. And if you're willing to invest your time, that time could have been invested to make you money, right? So that time has value. Similarly, though, is also this idea that relationships have value. And a lot of times, something you're going to hear me come back to again and again is how can you get more people invested in your success? And a lot of times, that is the relationships that do that. When you can get those without having to give away a piece of your company, all the better, right? But today, we are going to be really zeroing in on that first aspect, the money aspect. But yeah, it is stuff that gets invested into a business or idea oftentimes, as we're going to be talking about, because there's some hope of future growth. Just want to make sure if I'm losing anyone. Yeah, I kind of covered that. But yes, so Nick kind of mentioned this, some other folks kind of mentioned this, but why are people trying to take that capital? It's because you're trying to get greater value than otherwise you could. Now, that can mean that we might be able to say, okay, I could grow this business in 10 years to be, I don't know, X, right? And I know that that's part of my roadmap. That's possible. Now, if I take the capital today, if I take money from someone else, maybe I can get to that 10-year goal in 2 years. And now that can actually have a lot of value because standing here, we could just all imagine this, right? 10 years ago, could any of us imagine the world we are in today, right? Trump's in his second term, we've had COVID, right? Like, it's so hard to predict what's going to come. So sometimes, even when you know your business is growing steadily, you're able to kind of see the future path, that future is not certain, and being able to achieve that future in a shorter time frame makes it possible in a way that otherwise wouldn't have been possible, right? So a lot of times this is what entrepreneurs are doing, what people are doing when they're trying to take capital. The flip side is the investors are looking for a return, right? They're looking for a return on their capital, but they're going to have different constraints that are setting that are scaffolding what it is that they're able to do. And those constraints are what are going to influence those four things I've called out here: the structure of the investment, the time and the horizon of the investment, and the level of involvement that they're looking for. Investors are going to be looking for a return, but that return will have constraints based on the way they've set up their ideas around how they're trying to invest their money. I'm gonna double check one more time, make sure I kind of have talked to all the points that people were talking about. Yeah, okay. I think that I've kind of talked to those. Cool. So here's the kind of question, one of the first questions I want to talk about. And there's going to be four of these that we're going to cover over the course of today. But one of the things that happens when you go out and take capital is you're giving away some part of your business, right? So what happens when you do that, right? When you give away more control over your business, what happens? And you may remember there was three things that we were going to talk about today. So the first one was this notion of controlling capital. And that's what happens when you give away more control of your business. Generally, this means that you've given away 50% of your business, right? Generally, you've given away a majority stake. That does not always have to be true. Sometimes you may have controlling capital. You may have capital that's come in and now they're now controlling or dictating the way business decisions are made in this business, even without having taken controlling stake. And that's because some of the covenants that may have come in as part of that investment, especially for the debt investment, or in other ways, maybe there's an alliances, maybe you gave away a majority of the board seats, even though you didn't give a majority of the actual shares of the business. But there's different ways that capital can become controlling, even without giving away 50% of the business. But the key point is that now suddenly you have a player who's on your equity board, who's on your cap table, who now is having a stake in what decisions are being made. So I'm going to talk through an example for each one of these types of capital. And this is a deal that I was very involved in about, gosh, what, 2 months ago now? Yeah, we closed at the end of May. So it was the 1st of June was the beginning of it. And that was the end deal. So the start of the deal that I was part of started in 2019, and when this thing happened, I've called it here, which is there was a company called the Craftery, a VC firm out of the UK that made an investment into a business, a queer-owned business out of Seattle called Tomboy X, started by a dear friend of mine, Fran Dunaway, and her wife Naomi Gonzalez. Started in 2013, I want to say, and they are one of the underwear brands that's really targeted the women part of the queer demographic, right? There's a lot, as gay men know, there's a lot of underwear brands out there that are targeting us. There's not as many that were targeting other parts of the queer community. What Fran and her wife did is they built a company there. Now, they had a really interesting experience because in 2018, they went out and raised their Series A. And if I remember correctly, their Series A was at a valuation, I want to say, of maybe 10 or $12 million. And they'd raised a reasonable Series A, but not huge. I want to say it was maybe $3 or $4 million, right? So this is 2018. Less than 6 months later, they got interest, unsolicited interest by someone who was like, hey, we love your business. We really want to help it grow. Now let us come in and invest. And they were not super excited, right? Because they've just taken some money. But these people said, hey, we'll value your business at $40 million, right? So they valued the business at more than 2.5 times what had been valued just 6 months earlier. And they said, not only will we put $10 million into your business, we'd like to spend $8 million and buy out some of your existing shareholders. Now, this can be a really hard to say no proposition because you have these people who have been with you from the very beginning, right? These may be your seed investors and maybe your family that kind of believed in you and no one else believed in you. And now you have someone saying, hey, not only do I want to make a primary investment into your business, but I want to do a secondary transaction. I want to buy shares from people who have already been your investors. So Fran and Naomi were like, shoot, we also we haven't taken any money off the table, right? We started this company all these years ago. We've been making somewhat of a salary, but there's not that much money to be made every, how many, you make a couple of dollars per unit of underwear sold. So there's not that much money in this business. So like, we also have the opportunity that we could sell some of our shares and be able to kind of, they ended up buying a house and whatnot, all this stuff, right? So they did it, right? They agreed to this transaction in 2019. The craftery came in, and the craftery was able to buy out those people, and they got 56% of the company. However, they also took, so not only did they get majority share, they also got 3 of the board seats. So now what ended up happening was that though Fran remained on the board and one of the people from the Series A, and Naomi was there as an observer, Naomi didn't have a vote as an observer. So now they had 2 of the votes against the 3 votes. So over and over again, they were unable to kind of stop certain decisions from occurring. The key, really unfortunate decision that happened, and we think from the outside that we think the craftery had someone who they thought was going to buy this business. But about 2 years ago, they took a $4 million loan. And unfortunately, this was a revenue-based loan. All this is public, so it's like it's a company called Decathlon Capital. Like, they do these kind of revenue-based loans. They like to say they're very founder-focused, but this loan started at 21%. And last year it was almost 30%, right? Tomboy spent $1 million servicing this loan last year. It was on the verge of pushing the company into bankruptcy. I mean, it would have pushed the company into bankruptcy, right? The company was on track to run out of money this year. And we went to the craftery and we are like, listen, guys, like, we don't think you're running the company well. We think it's clear it's lost value. It's about to go bankrupt. You should sell your majority stake so that we can get control of this company back. And we can now go out and actually lead the business in a way it was being led before you took this, absolutely suffocating loan. And a bunch of other kind of decisions, really cutting costs to a point where it's just like, if you may have even realized before this year, Tomboy X just said stop being at Pride parades. And they were a real fixture of Pride parades all the way through the 2010s. And it's just they had such a focus on cutting costs because they had this loan and they had these VCs who just weren't as worried about the kind of the queer community as kind of the founders were. But when you've given away that majority control, when you don't have majority of your board seats, you don't have full ownership of your company anymore, and you don't have some sort of special provision that somehow lets you have more say in the company, even though you may have less physical shares. This is what a lot of the tech founders do, where their shares will be worth 10 votes for and other people's shares are only worth 1 vote. But when you don't have those things, you've lost the ability to kind of dictate the direction. So Crafty refused. It was crazy. Like, they were like, this business is going to go out of business. And they refused to sell us their shares. So we did what is actually called a recapitalization. And it's something that is hard to do unless there's, the business is on the verge of bankruptcy. But we said, listen, we will put more money into this business, but we're going to dictate what terms we're going to put it at. And we invested $5 million with kind of a consortium. Fran and I raised the money. But we invested $5 million at a $5 million valuation, right? So this is a far cry from the 40 million it was in 2019. But what that meant was that now 50% of the new shares were issued to the new investors. So now we're able to take back majority control. We can reconstitute the board, and we have the ability to set the direction of the company once more. Now, was this a great outcome? I mean, what happened, right? So immediately when the controlling new capital came in, when the craftery came in, we had to adjust the board members, part of the deal, and the control of the priorities shifted, right? We started to see less investment in the brand marketing, and eventually, the big decision was we were not able to stop this loan from being taken, that we really were stressed about its ability to shape the company's future, and it turned out to be true, right? It really did shape the company's future in a negative way. And then this medium term one, I think, also is worth calling out, right? And that's something that I've experienced now as I spend a lot of time with the leadership team. It just happens, right? When you don't know who exactly is going to be opposed, you end up doing a lot of things to kind of cover your ass a lot, right? People want to make sure that they're making decisions that they're not going to get in trouble for. When it feels like things are shifting, or it feels like there's disagreement in these kind of like higher parts of the organization, you find people less likely to go out on limbs. So that can have this chilling effect where it's like, we're not going to take these bigger risks. We're not going to take these things that pay out for a longer term. We're going to take the things that we know we're going to hit the goals that the company says they're most focused on. That sometimes can lead to a cost of the goals that are actually need to be focused on for long term. Um, so I will pause. Yes. To answer Josh's question before I go on to the next type of capital, Josh was just asking, could having certain language in the bylaws, possibly as a benefit corporation, have prevented private equity from coming in the first place? So Tombox actually did move to being a benefit corporation after the investment. Um, yes and no. So at the point of a lot of ability is given to the board of directors to be able to change things, frankly, right? So in the transaction that we did, there was a lot of preferred shares that actually had certain rights. But we wanted to be able to get this transaction through in a short period of time. So, for example, we extended pro rata rights to everyone in a way that we wanted to, but not necessarily in a way that was contractually obligated. The way we did that is the board voted to change all preferred shares to common shares before the transaction happened as part of the transaction. And like the board can do that, right? So, yes, you could have something in the bylaws that could restrict something like that. Could the board vote and change the bylaws before the transaction happens or as possible part of the transaction? 100%. So, yes and no, right? If I'm not 100% certain about the specific part of your question as to whether or not a benefit corporation could have stopped. To be fair, this was also venture capital. This wasn't really private equity, but I would need to double check. I don't think so, though. I'm pretty certain that it's the same thing, right? Like even when you kind of put these constraints in, there's so much ability for your board to change it. I guess the only way would be is if that you, because a benefit corporation lets you do a double bottom line, so you can say that the board has a fiduciary responsibility, not just to capital, but not just to generate money for shareholders, but also has a second kind of equally responsible responsibility. So if you said something like as part of why it's a benefit corporation, it is to, I don't know, like return money to share support its employees and not be diluting of any existing shareholders or some you maybe could find some language in there that would stop the ability for kind of outside capital to come in. But something we're going to talk about today is it's not always bad, right? So I will come to kind of that point of when you might consider that you do want to give away controlling stake. Anyway, please feel free to drop questions and I'll answer them when it makes sense. But yes. Okay, so coming to our next question. So when you get a partnership, how does that affect your business, right? And this is what my lead into talking to you a little bit about strategic capital. So strategic capital could have been what the craftery was, right? Strategic capital is capital that comes in, and it oftentimes is stuff that is where you're making a partnership that may or may not be because you have a financial necessity right now, right? A lot of times when you're taking strategic capital in, it's because you want that person to be part of your journey. You want to have them vested in your success, and you want to have this other player in your corner, right? And one of the best ways to know that someone is definitely in your corner is when they have a financial incentive in seeing you successful. Strategic capital can be coming from other organizations, which is the example I'm going to be talking about today. It also could be coming from a smaller player, right? Maybe you're looking to expand into another country and you're looking for, and having a strategic partner there, having someone who's invested in the company from that other country can open those doors for you. So it doesn't always have to be another company. It could be a smaller player as well, whether that means a high net worth individual, family office, or a different type of player. And just to give a little plug, we do talk about those different types of capital in our first workshop. So if you want to go check that one out, it's on the Startouts YouTube page. But the one I want to talk about here is Rover. So rover.com is a website that I think, if I remember correctly, they originally built themselves as Airbnb for pets. One of my former roommates, who we lived together for many years, actually was a co-founder, Philip Kimmy, and so it was something that I got to see kind of close hand during those early years. It was actually started as a place for Rover.com, which was a cute idea. The idea of dogs named Rover. Um, but Rover, this was a really interesting deal, right? Because this was a moment when Rover was not looking for money, but they were looking to establish themselves as the obvious choice when you wanted to have someone take care of your dog. Now, we may forget this a little bit, that it wasn't so obvious at the time that Rover was going to be the most successful. It was a small startup out of Seattle. There were a couple of other ones. whose names are escaping me right now. And it was also a point where we were still kind of growing comfort with the idea that you are going to just have a stranger that you're matched with through an app, and that's suddenly going to be a relationship that's going to be useful to you, right? So it was not as obvious that Rover was going to be successful. I want to say this was 2014. Oh shoot, I did not write that down. But yes, it was not as obvious it was going to be successful a decade ago. But why would they do it, right? And so here's I'm talking about some of the reasons why they would do it, right? Suddenly, when you have someone like Petco, it opens all these doors to you. As a direct to consumer brand, as a D2C brand, Rover did not have the physical presence across the country, nor did it have the legitimacy, right? It just looks like an online website. And it's the same kind of value that you sometimes will see actually, I'll be a kind of a. I was going to give you a little connection to my earlier story, but I want to focus it here so we don't get a little bit confused. So yes, right. It gives them access. It gives them access to customers that they may have not had access to otherwise, and even more importantly, it gives them access to a part of the audience that's probably not aware of their solution. Right? There's a certain kind of people who were understanding that there was a tech Airbnb for dogs in 2014. That was likely not to be a lot of the people who were shopping in store at Petco. So it's giving opportunity for you to access these customers that you wouldn't have been able to access otherwise. And then also in this case, they were also a very quiet partner, right? So it was a relatively easy deal, right? They brought a new board member, right, which gave some, as I was saying, more market access, and it created these kind of opportunities that were available, right? You could go out and get vendor relationships now. You were respected more because now you have this legitimacy, but there wasn't as much of a bias the same way that there was when the craftery came in and took a controlling stake. This is also because the type of player, right? Petco is running their own business. They're not as interested in helping you kind of dictate what it is that's happening in your own business. So sometimes when you're looking at the characteristics of that investor, that can also really help you in being able to understand where is this investment going to go. But I have called out here on this last thing that there is this thing that starts to occur, which is this strategic gravity notion, right? It's like when we're going out and going to do a deal with a I don't know, I need a good example now. Like, let's say they're going to do a white label kind of, if Rover was going to do some sort of white labeling solution, right? Now you're going to be obviously biased to your partner. Right. So the strategic gravity that starts to occur is when you know someone's on your cap table, when you know someone has an observer board seat, it just becomes an easier conversation to have. It becomes an easier way to easier path to go down. So there is worth considering that even when you have a less more passive partner, even when you is a little bit more just strategic and less controlling, there may be this kind of strategic gravity that kind of gets pulled. Okay, I'm gonna drink a sip of water before I come on to that last one. Mm. And besides, this is a fun question to kind of leave up there, right? So you may be wondering this by now, right? Like, when do I actually get people who are just going to be my investors and leave me alone? What do we call those people? And we call those people passive capital. Now, passive capital can take all sorts of forms. It could be your parents. It could be a high net worth individual. It could be uh, uh, some sort of equity grant that maybe a accelerator is doing. There's all sorts of money that is willing to kind of come in and have less sort of impact, but they have their own constraints as part of it, right? And if I could take you back in your mind to kind of what I was talking about on that third slide, right? The types of investors that are going to be willing to come in and write you a check, kind of like without too much control, without having too much of a say in what the operations of business are going to be, are generally investors not willing to write as big of a check. Right? So these kinds of trade-offs are going to exist. When you are trying to get easy checks, the likelihood is they're going to be smaller checks. The checks that are going to be bigger, the checks that are going to let you kind of close your round faster, are often going to be the checks that come with constraints. This is always going to kind of be that trade-off. However, sometimes you can find people when you are running a business that is very solid that want to invest and be part of that success. In this case, I'm going to actually talk to you about my father's business. And so this is an investment that my father's business took about maybe 7 years ago. And at the time, they were on a tear. The business had done $80 million in revenue that past year. And they were looking to see what would the world look like, right? Like maybe we should sell, maybe we should not sell. And then they met these folks. These are the George Oak partners. And they were like, you guys are on such a tear, right? What if you could think about maybe expanding your business in certain ways and continuing to run it because you built an operational team that seems very strong? So they're not looking for very much, right? Like, they were looking for 2 board seats, but they were looking to say, we want to invest our capital because we think you guys have the team, you have the ability to grow this capital. And so they did. They went out and they invested the capital. And that was enabled the company to go out and buy this business in LATAM. Now, if you guys know other the technologies, are they're an Indian-based outsourcing business, and Indian-based outsourcing was very, very successful for many years. Recently, in the last 5 to 7 years, it's become more of a desirable to have what's called nearshore outsourcing, so the same time zone. Now, the company took some strategic capital, right, from these passive players who are willing to kind of give them the money and say, you guys know how to do this, you know how to run this business. But they helped open some doors. They had some experience in LATAM. They knew about this company. And so they went and bought this company. In the last, like, I think Legacy closed this last year doing 250 million in annual revenue, right? So these last 7 years have helped them grow incredibly, right? They've now really kind of established themselves as a different player in the industry because they took that passive investment. So, what does that look like? Right? These are generally the kind of characteristics that you'll see. As I kind of been harping over and over again, is that the passive capital will often come in assuming that your operational team understands how to do things, right? The decisions are going to stay with the founder or stay with the operational team, and they're going to come with the trust that that you are able to kind of run and grow the business. Now, that can be difficult at times because sometimes the skills that were needed uh, to grow the business initially are not the same skills needed to grow the business even further. So, to give you another example, mm, kind of a complicated example. I think I'll come to that example in my last couple of slides. But the high level of the notion is this, right? That when you're taking these kinds of larger checks, when you're starting to bring a lot of money in, it comes with a lot of responsibility. And sometimes being able to have someone in your corner who's actually going to talk and not just sit silent in your board meetings or maybe just not even come to be part of your board means that you have someone who's sharing the burden with you, who's able to kind of be your sounding board, be the people who can help guide you and how you're growing this business. Because we would hope that if they are investing in this business, that they maybe have invested in similar businesses in the past or have some sort of an experience that can be very helpful to you. So the flip side of where you may want to actually think about looking at your investors as a place of growth and a place for additional knowledge and help is where you would want to start to think about saying, hey, do I want to be taking people who are going to be taking more of an active stake in my business? So this brings us all to the kind of question, right? What do we actually do? This can be really a hard question, right? Like, there's obviously advantages. It's obviously hard to know what the future is going to bring. Like I was talking about a few minutes ago, we could have never predicted 10 years ago what the world would look like today. And raising money can really help you on that journey. It can help you be able to get to the future that you're trying to get to faster before the world changes around you, before AI eats all of the jobs and suddenly we're, printing everything, no one's buying anything, right? So because any market opportunity is a limited opportunity. Nothing is going to stay the same forever, right? The only nature of this world is that things are changing around us. So we know that the market opportunities are limited. So getting to that market opportunity faster is very, very valuable and will, in my opinion, be one of the number one reasons why you would want to consider raising capital. Secondarily, maybe these other ones that we've talked about, right? Good partnerships, it's opening doors for you, it's getting people in your corners, but it's really got to be centered around the notion that you're going to be able to achieve a future that you wouldn't be able to achieve as quickly or at all otherwise. But here's a little bit more details. So, right, here's a kind of like way, one of the models that you can kind of go back and forth around it. So, yes, I could keep more control and responsibilities. But just because my team or I was the right person to get this business off the ground, right? I could bootstrap it. I was willing to work 80-hour days. I was willing to kind of fix things in my sink. That may not be possible once we now have 100 customers that we're serving every day or 1,000 customers that we're serving every day, right? So really kind of keeping in mind that the challenges change, and the skill set that we bring, even though it was the right skill set for an early part of the challenges, may or may not be the right skill set later on. That's not to say you can't grow that skill set or learn it, but sometimes having guidance in that can be really, really helpful, and it's worth giving away part of your company for, right? It's better to own 20% of something that's actually worth something, even 20%, right? Than it is to own 100% of something that's failed, right? So and to go back to my earliest example, right? Like that was part of the calculation that I think Fran did, where it was like, it's better for me to own something. It's better for me to give some money back to my investors so that I have the ability to go back to them in the future. I've returned money to them, even if I have to give away ownership control of my business. And they may have been right, right? Like maybe we wouldn't even have made it this far, right? The business is doing 25 million in revenue. Sure, it had this crippling debt burden that we had to get it out of, but it is a very efficient business. And maybe that would have never happened if we didn't have venture capital really running it for a while and kind of forcing, like tightening the screws on every single metric for 4 years, right? Um, well, this is my kind of thinking about it, right? This is how I go back and forth when I'm talking to businesses, when I'm even just trying to weigh the considerations for myself. Something that Divya and I have talked a lot about is should we consider raising money, right? Because I've seen some success in my past, right? I've already run a business or two, right? So I could put more money into our business that could help us, but that's the question. It's help us get to what future? We're running a services business that does consulting, right? We do workshops like this. We help people figure out their brand stories. We help people build their products. We have a really cool product right now that we're designing for a company in India. We're doing the entire first experience. But does it do what would the money I invest in the business do? Right? It's not, and sure, maybe we could accelerate hiring, but is accelerating hiring the thing that's holding our business back? Right now we have revenue coming in, we have a little bit more capacity than we could be having. Maybe we could go out and run some more marketing. Well, but again, it's like, is it worth it? Right? Like, what is the future that I'm accelerating? It's a very hard sell, in my opinion, for any services company to go out and say, I want to raise money in the hopes that I'm going to grow faster. Generally, generally with most services, especially the kinds of services that you're delivering yourself, especially consulting sort of services, bootstrapping your growth means that you can keep learning as you're going along, and you're growing at a speed that's sustainable for you, right? That we are able to actually deliver all the projects and deliver the workshops we're committing to at the quality that we're looking for. Another kind of trade-off that can happen is if you're not able to support your growth, now you're creating broken expectations and you're not delivering as good of an experience. You have to support both of those sides as you're kind of erasing. It's a complicated battle for services. You can see it with products where it's like, oh, I need to be able to get to a certain volume to be able to do my orders. Or I need to be able to get to a certain volume to work with this retailer. Services can tend to be a harder battle, or harder justification, I should say. Um, yeah, and then I think this last slide I want to just say, but I kind of hinted at, is that one of the things that can be really helpful is just in getting that initial product market fit. If you were there last week, I'm sorry, last month when we were doing this workshop, I took everyone through this hypothetical of this guy who was starting a lemonade stand, right? And at first, he was having trouble getting resonance with the idea, right? Nobody wanted to give him money for his lemonade stand, and then he went to organic lemons and pink lemonade, right? So sometimes what you need that little bit of funding in order to figure out what are the twists I need to make for this initial idea to actually get the product that people are looking for, to actually get the product that will command the price point that I want to be able to sell the product at. So that is still something worth considering, right? I was cognizant when I went through this deck the first time that I was building something that was kind of convincing you not to take capital. And that was what I really wanted to put in these last two slides here to just reinforce there are reasons why you would, right? And this can be a really big reason why. You're early on in your cycle, you have this hypothesis. Maybe you've I don't know, realized that reading in bed is really shitty and all of the lights today always shine in someone's partner's eyes. So you have this hypothesis of like something that could be done, and maybe you like tape together something with duct tape that you think would work. Now, should you go out and spend your own money trying to get that first product in market? Maybe you know there's a bunch of folks who also care a lot about reading in bed, and you can go out and be like, guys, I'm going to make a solution. I'm really excited about it. I don't know if it's going to work, but I think it might work. Can you give me $50? Can you give me $100? And can we try and see it? Can you be part of this journey with me? Because that at the end of the day is really what it's all about, right? Is that the more folks that you can get to be part of this journey with you, the more you're able to feel like you have a community that's part of the journey with you. And that is what's eventually going to make your product successful, right? Capital is very, very important. But capital also is very important because it gets people on that journey with you. People who have invested in your company have a stake in seeing you successful. And when you're out trying to sell your first few products, when you're out trying to sell your first few services, it's so useful having people in your corner. So at the end of the day, right, I would come back to that notion most of all, that whatever you're kind of doing, whether it does mean that you're letting people invest in your business, you're giving them some equity stakes from it, or whatever else, the most important kind of thing you can do is get people in your corner so that when you're out there trying to navigate things that are in front of you, you have some folks that you can talk to and you can try and build this business with. Cool. Um, Happy to kind of pause here for some questions, if any came up to you guys as I went through. Sometimes I know I tend to talk fast and I get excited, so also happy to recap any slides if I did zoom past them for you. They will be on the recording as well.
Awesome, Karan. Thank you so much. As always, fantastic information. I think part of the conversation, and thank you for breaking it down from such a foundational level of like, what is capital? Why do I need it? How do I use it? I think a lot of so my experience working with folks at startup, a lot of folks are constantly like that. Like, I need capital. I have to grow. It's the only way that I can do it. But those questions of the impact, the examples that you shared about how capital can actually kind of be detrimental sometimes when there's too much control and power. I think if you can kind of recap that, like what's like the top three things that you think you need to really think about before you decide to take on capital?
Yeah, for sure. Um, so I think the first question that's really important to have an answer to is what you were going to do with the money, right? And I could actually tell you guys a story of a different company that didn't make it into the deck. But there's a business out of Seattle called Humanly that I invested in probably maybe 6 or 7 years ago. And about 3 years ago, the founder, this guy named Prem Kumar, was talking to me about he had been approached basically by a an angel consortium in Texas. If I want to remember correctly, they wanted to invest something like crazy at the time. Like he had just closed maybe an $800,000 round, and they were like, "Can we invest $7 million in your business? Like we really think this is going somewhere." And Bream was like, "Fuck, man, like maybe I should," right? Because like I wouldn't have to raise another round, right? Like I would actually could be done, right? Like I think that was he had just raised a seed, and he was like, "If I raise this, I don't even have to do a series A or B." Like he thought he could just be done with that. And we went really, and he was really torn about it because he was like, you know, like it's so much energy and time to go out and fundraise. And that is something I have not highlighted, but all of you will know as soon as you go out and try and fundraise, it is so much energy and time because getting yourself back up after a no, or figuring out what kind of feedback do you actually change, what feedback do you ignore, how should I tweak this? It takes so much of your mental space out there when you're out fundraising. So it was no joke. Like it was that being able to escape from doing future fundraising rounds is very valuable. But you know, there's always the question is what how much of the business are you going to have to give away and what are you going to use the money for? Right. And both of those were not good signs for Preem at that moment when he was trying to make that decision for Humanly, because what was he going to have to give away was more than he would have to give now, right? Like he just finished raising his Series B. I think he raised $10 million in a week. It was crazy, right? Like, but he was on a tear. The business is doing super well, and they were able to go out and raise that money all from existing investors. All his earlier VCs came back into the round, right? So he was able to. So when he needed the money, he was able to raise it, and he was able to raise it at a much better valuation because at this point the company is worth so much more than it was 3 years ago. So that's a big kind of question, right? It is really nice to get the money in the door and to not have to raise more money, but you will have to give away more for the money because the company is not as valuable today as it will be in the future if you're being able to use that money to grow the business as you hopefully are. And then well, what's the first thing? But the first thing was really what were we going to use the money for? And that was a big problem, right? Because Preem had not planned for $7 million. He had planned for maybe 1 million at best, it was 800K around. So that's just not helpful. I think we all respond differently to having money kind of in the bank, but something that I find has happened as the businesses that I've been part of is just you end up being a little bit more lax with your financial controls a lot of the time, right? It's like, hey, we really want to get this thing done. Oh, we're slipping. Should we get a copywriter in just to help us finish this part of it? And suddenly those decisions become decisions that weren't, and they can just really start to eat away at your margins and really start to eat away at the kind of financial records, right? Showing the EBITDA growth, or particularly EBITDA growth, but showing kind of the earnings growth that people like to see when you're out and raising those future rounds. So sometimes having that money in the bank can actually create bad behavior that makes it harder for you later on. So I would say those two are kind of the biggest thing, right? Is one is what are you going to do with the money, right? Really understand what purposes are you going to do with the money? And it's totally fine to say that part of the money is going to be used as a buffer to be like, hey, we're keeping 10%, we're keeping 20% of this round because we know that there's going to be shit that we have not anticipated and we want to make sure we have money for that day, right? That's a totally reasonable thing, but that's still a thing, right? That's you sat down and said that this money is going to be my buffer. I'm going to use it for that. That is great, but know what you're going to use the money for, set out and raise the money that you're actually going to use, and then just be cognizant of how much money you're giving. I'm sorry, what percentage of your business that you're giving away as part of that.
That's super helpful, Karan. I think it's important for folks to the what do you actually use the money for is super important, or what do you need it for? From a non-VC perspective, I remember getting a grant once in a nonprofit, and we got more money than we expected. And everybody's like, "Oh, this is great. We're going to buy this and do this and this." And if we had just put that money away for a little while, it would have been helpful because it was 2020 and it was February, and we did not realize. But some questions have come in. Do you have any specific questions a founder should ask a potential investor, particularly if they're looking for passive capital?
Yeah. Um, so I think some of the questions that I really briefly had on that slide, um, oh my goodness, where was it? Where here we are, right? So understand from them what kind of structure are they interested or willing to tolerate, and what kind of time horizon and level of involvement, right? So the to kind of go into those a little bit, and perhaps I'll do a future workshop on these, but structures can take a couple of different forms. One can be what someone asked about in this later question, which it could be a safe, which is a simple agreement for future equity safe. But so that's an equity agreement, right? Largely equity or debt are the two types of things that you will be getting out there. And then it can be equity for stock right now or equity for stock in the future. And it can be debt that can be converted to equity or debt that has an interest rate or doesn't have an interest rate. So those are largely the structures. And I'll talk a little bit about all those just really briefly, but it's not crazy complicated. But basically, if someone is telling you that they're looking for a debt investment, that they're willing to give you debt, that this would most likely follow one of two scenarios. Either they are willing to give you debt that is interest free, or is debt with interest. If it is debt that's interest free, it's likely they're wanting to convert it to equity. And in that case, it's a convertible note, and it's most likely the same as a safe mentally. Like you can think of a convertible note and as a safe as relatively the same in structure. Both of those are letting you take money today and then being able to convert it on a future value of the business. So I'm being able to say, even if my business is right now, it's just my idea, and I'm really optimistic about my idea. So I say my idea is worth $1 million, and I go out and raise $100,000. Okay. Now, if that's on a safe, I'm being able to defer the day that converts. So instead of it having to convert today and me having to give away about 10% of my company for them because they are getting 10% of this business that I said was worth $1 million. Now they put $100,000 into it. So, right. Um, I'm being able to say that I'm going to convert you. I'm going to maintain this as an obligation that I have to convert you and give you the equity, give you the actual shares later. And that's what a safe does, and that's what a convertible note does. And both of them will have the conditions they convert as part of the agreements. Separately from that is you may have someone who's willing to give you debt, and it could be called venture debt, or it could be they're just giving you a loan, and that'll have an interest rate associated with it. Those will generally have covenants associated with it. The covenants are largely the long and short of your relationship with them, right? There was a business I was part of. There was a covenant that you couldn't spend more than $1 million in credit, right, across your credit cards or everything. They never wanted the business to have more than $1 million run in open credit, and that was a covenant as part of the loan that this lender gave. But it largely will be they'll be limited by the covenants. They're not going to be a part of your board meetings and kind of saying like, hey, don't hire this person, right? They're going to give you some restrictions, but they'll be as part of that. So generally, if you have someone who's interested in giving you a loan, you can imagine that that's going to be passive capital. Outside of that, I would say understand from them what kind of time horizon, right? And then, you can ask them obviously what level of involvement. Sometimes you don't know, right? And they also may not know. So you can look at what you've contractually allowed for them. Do they have a board seat? Do they have an observer seat? What kind of information are you promising to give them every quarter or every year? Are they part of your board meetings in any way, right? So those are all kinds of things that are it will be in your investor agreement. They'll give you some sense of how active or passive they're going to be. But one of the big things I think that people forget to talk about is time horizons. So a lot of folks, right, funds will have a horizon associated with them. Most funds will make most of their investments in 5 years. And then the sixth, seventh, those years they're starting to look for a return from their fund. So understanding when was that fund inception, did it start? And then when are they looking to return funds to investors? That gives you a sense of the time horizon of the fund. But even asking your investor, if it's a personal investor, what kind of time horizon? Are you looking to see a return in a year, in 2 years, in 5 years? Generally, the longer those horizons are, the more space they have to be passive and kind of give you space to run your business. If they're looking for a return in the shorter term, that can kind of be a red flag around if you don't have a plan to give the money in the short term, that suddenly, 2 years from now, they're going to be a real active player to you and be like, hey guys, I would like to start seeing a return pretty soon.
Awesome. Thank you. And then the question around seed, and if you could break down seed and all of the series. Quick summary.
Yeah, that it's funny that's yes, it is funny because it's really transformed over the last like decade or so. There used to be kind of ideas around what size rounds were. There were the time seed rounds were like under 100K or under a couple of 100K. Now those numbers have really changed, but what they really just refer to is what number order round it was. So generally, a seed round will be your first round. You may have taken money from friends and family before that as part of your seed round, or even a pre-seed round. But generally, the first money you take will be called a seed round, or maybe a pre-seed round, and it may be pretty small. It may be 100,000 or even less, right? Depending on the kind of business you're in. Series A's, there was a time, again, right? $1 million Series A would have even been crazy. Now you might even see a $5 million Series A, right? So the numbers have kind of stopped being as good indicators anymore. But they will, once people have raised a seed round, the next round they raise will be a Series A. The next round will be a Series B, and it will go all the way on. Um, I see my father has actually joined us on this call, but he actually was part of a business that went all the way to Series H, right? So those numbers just keep going. So it's very much just a measure of what number round there are versus it kind of being a real implication about how much money is being raised in that round.
Awesome. Thank you, Karen. And then last question, if there's not a planned exit in the short term for a new startup, what kind of return options exist for early stage equity investors?
Yeah, so that's what was driving Fran in that first example I talked about, right? A lot of times there is not great options other than somebody offering to buy out some of those early investors. And so that's what happened kind of when she found someone came in 5 years into her company and was willing to buy out some of those investors. It was a big draw for her because that is not super often available as an opportunity until a bigger transaction happens, right? That was a relatively small transaction in order to be giving an opportunity for liquidity for those kinds of investors. It's something that you can ask for, right? You can ask for the right to be able to sell your shares back to the company or back or to a future investor as part of your round. That's not an unreasonable ask at all. So when you're making that investment in your Series A or an early stage investor, you can say that I would like the right to be able to sell these as part of a future round. And depending on how that's structured, it may be like technically the business buys them from you and then they get sold to the future investor. But that is a right that you can ask for. Whether or not they grant it, of course, is a separate thing. But really, the only way is usually from future money coming in and that buying out the shares of previous earlier stage investors.
Fantastic. Thank you. While we wait to see if there's another question, I did want to post into the chat. Please make sure you share your feedback on the workshop so that we can share this with Karan and Divya for future workshops. I've also linked a document that includes the recording from the previous workshop. We'll add this recording to it as well, and then you can RSVP for the upcoming workshops as well.
There's going to be 2 more in this series, so. Cool. And then feel free, you guys can reach out. It's just Karan, Kahran at joyus.studio. But if you forget, just go to joyus.studio and you can find my contact there.
I have a quick question.
Tell me.
Thank you so much. So I feel like passive capital is like this holy grail that we like all kind of want, but sometimes it's hard to find. So, I think if we have high net worth individuals in our network, I think that's like an easy answer. I've heard family offices as well. Do you have any other suggestions on like how to find this type of capital?
Yeah. So there are people that are really focused on the fact that this type of capital has been largely steered towards certain groups, and it was like straight white men. And so when like as not being part of those groups can be helpful, right? There are investors who are excited about funding queer organizations, women, right? Maybe not applicable for you, but, right? So there are these kind of different groups that you can reach out to. At the end of the day, though, right, like people are investing in something, and I think generally the ones that are going to be more willing to kind of take a backseat to the operations are ones that believe in you personally, right, and believe in your ability to execute. And so those relationships generally are not built quickly, right? So it'd be ones that you kind of have met. I mean, I don't know you, right? Like maybe you are someone who can kind of build those relationships relatively quickly. So that is possible. But I would just keep that in mind that like, it may be less the strength of your idea when you're out shopping those things than the strength of your relationship with those people, and thinking about it in that way can be really helpful. Yeah, we have a minute or two. So one of the investors who came into this fast round was for Tomboy X was one of the co-founders of Shopify. His wife actually was the one who kind of really made that final decision to be part of that investment. And she's someone I probably spent maybe, I don't know, like an hour on the phone with every 10 days or so for maybe 5 months. Right. Like, and sometimes it was more than an hour, right? We had a bunch of video calls. Like I talked to some of her team about some various stuff that she thought maybe I could help them like kind of think through. Right. So it was very much about like building this relationship over time. And at this point, right, like it's been 2 months since the deal closed. Like I've texted her a couple of times. She hasn't really asked me anything. Right. And she was like one of our biggest single investment like checks written for the round. So that can happen, right? Like you can build these relationships over time, but very much you're looking at it as it's a relationship building exercise versus it kind of being like, oh, I'm going to sell you on why this is the right solution for this market and why you need to invest right now. And, it's just a different kind of sell.
Makes sense. Thanks so much.
Of course.
Awesome. Perfect, Carmen. You're getting some love in the chat as well for a fantastic workshop.
Thank you.
Awesome, y'all. Well, again, thank you so much, Karen and Joyus Studios for being with us. We appreciate this and look forward to the next 2 workshops. You named your dad was here, Dad, making you proud. He's making you proud with really fantastic workshops and sharing his knowledge with the startup ecosystem and beyond. So thank you all so much. Enjoy the rest of your day. Make sure to check out startup.org for future events, and we'll see you at the next one. Bye, all.
Thanks.